Let's continue on talking about stockholders' equity. And in this, we're going to focus a little bit on share-based compensation. Employee compensation plans frequently include share-based awards. These awards are in forms of payments whose value is dependent on the value of the company's stock. These may be outright awards of shares, maybe some stock options, or even some cash payments that are tied to the actual market price of the shares. Sometimes only the key executives can actually participate in these programs. But a lot of the times, key executive compensation is tied to the performance of the company. So the better the company does, the better the stock does, of course, the higher the compensation. There are variations of share-based compensation plans, almost to the point that there could be an endless, it seems, combination. Whether the plan is a stock award plan or a stock option plan or a stock appreciation rights plan, or one of several other similar plans to this, the goals are to provide compensation to designated employees while sometimes providing those employees with some sort of performance incentive. Likewise, the goal and accounting for each of these plans are the same for each. One, to determine the fair value of the compensation that we're paying out, and two, to expense that compensation over periods in which the participant performs the service. Back to the whole expense recognition, we recognize expenses in the time period that help us generate revenue. So stock awards and stock or share-based compensation is that same concept. We have to make sure that we reward or record the expense in the period that we receive the benefit. Now, there are two primary types of restricted stock plans, and that's where we're going to begin. We're going to start with restricted stock units, but there's also restricted stock awards. But let's start our discussion with restricted stock units. A restricted stock unit is it's a right to receive a specified number of shares of the company stock. RSUs have become a much more popular form of compensation than their restricted stock award friends or cousins. A restricted stock unit is a right to receive a specified number of shares of company stock. It could be a performance bonus or maybe a signing bonus, or it could be part of regular compensation of the employee. The employee doesn't receive the stock right away. Typically, the shares are distributed as the recipient of the RSU, the restricted stock unit, satisfies the vesting requirement. And the vesting requirement would be different for each individual company. The recipients benefit by the value of the shares at the end of the vesting period. The shares are not issued at the time of the grant. Delaying the increase in the outstanding shares is more acceptable to other shareholders. So when we're talking about stockholder or restricted stock units here, a couple of key things to remember. The company only distributes the shares after the recipient satisfies the vesting requirement. And the recipient benefits from the value of the shares at the end of that vesting period. Okay? And there's various terms of RSUs. Sometimes they're given the cash equivalent to the number of shares, so instead of actually receiving shares, they're given cash instead. Or the terms might stipulate something like the recipient or the company is allowed to choose whether to settle in stock or cash. So there are some limitations there as to what will happen, but how do we actually account for them? So let's look at this. And again, remember, our goal here is twofold. One is to determine the fair value of the compensation when we're looking at this, and then to expense the compensation over the periods in which the participant performs the service. So in other words, if I say, hey, over 10 years, you get 1 million shares of stock. Well, you didn't earn all that stock in 1 year. It would be spread across the 10. So in accounting, we must spread that expense over the time period in which it helped us generate the revenues, the performance piece, so to speak, of the company. So let's look at this problem. On January 1st, 2018, VKI Corporation awarded restricted stock units, RSUs is what we're typically going to say here, so just remember RSUs is restricted stock unit, representing 8 million of its $1 par value common shares to key personnel, subject to forfeiture if employment is terminated within 3 years. So in other words, as of today, you have these rights, but if you lose employment within a 3-year period, you will lose those restricted options. So that's your vesting period there. After the recipients of the RSU satisfy the vesting requirement, that's at 3 years, the company will distribute the shares. So in this case, we're giving out shares, not necessarily cash. On the grant date, so this is actually on the date granted, the shares had a market price of $8.10 per share. So the first question, determine the total compensation cost pertaining to the RSU. So this is the total cost overall, not necessarily when we would recognize the cost, but the total cost of us giving this RSU. So to find the total compensation on these units, what we're going to do is we're going to actually take the total units or total shares that we're going to give out, and that's 8 million shares. And you can either just do 8 or type it out there in the full. And then we're going to actually take those 8 million shares and we're going to multiply them by the market price on the grant date. So we're going to take 8 million times $8.10. And when we do that, we get 64,800,000. Okay. So that's going to be the total compensation to our actual employees. So what are we going to record for this one? Well, we already know it's 64.8 million. And since it says million, we want to put that in millions there. So 64.8 million. That's the total cost of these RSUs. So for RSUs, they're not too bad. We're going to take the 8 million times the market price on the date of grant. And that's going to give us our total compensation expense at the time this was declared. Now it says prepare the appropriate journal entries. Well, keep in mind on January 1st, we don't owe our employees anything. Zip, zero, nothing. What do we owe our employees? Well, after they work for a period of 3 years, then we actually owe them that. So in essence, these restricted stock units accrue over time. So for every year that you work for us, you're going to be allocated a small percentage of, or well, a third percentage because it's a 3-year vesting period of the total compensation. So on January 1st, when we actually declare them, they haven't earned anything at that point because no time has passed. Oops, let me turn off cap locks. No time has passed yet, so we don't have to record anything on day one. We will accrue them over time as the vesting period is sort of what's the word I'm looking for? As the vested period is earned, I guess. So for every year they work for us, they're going to earn a certain percentage. If they quit within those 3 years, they will lose that compensation. All right, so prepare the appropriate journal entries. Now, it does depend if we expect them to stay all 3 years or leave. So if we have a termination, then we have to change our entries. But on this one, we're just going to carry through as if they work the entire vested period. Then in a future problem, we'll look at, well, what happens if that termination or forfeiture occurs during that period of time. So in December, what do we need to record? Well, at this point, they've earned 1/3 or 1 year out of that 3-year vesting period has now been earned. So this becomes compensation expense because we must recognize the expense in the period that they help us generate. And since it's a 3-year period that they earn these 8 million shares, then each year we're going to recognize 1/3 of that. So if we take 64.8, so we're going to go in and let's just go up here. So 64.8, then we're going to take that and we're going to divide that over that 3-year vesting period here. Whoops. Divided by 3. Can't type, y'all know that. And then when we divide that out, 64.8 divided by 3, we get 21.6. Yeah, I didn't go to the next line. So 21.6 is the amount of compensation, assuming no forfeiture occurs, that we're going to go in and record each year. Now, what does that impact? Well, think about this. It isn't our expense to our company, but when we give out shares, that's owner's contribution. So as our employee works and generates compensation, they're actually in the end doing paid-in capital because they're paying into our company in theory for our restricted stock. Now eventually we will look at how to convert that over here on December 31st, way down here. But for now, we just simply put that compensation into those restricted stocks as they earn them. And then once they fully earn and we hand out the shares, then we'll convert that paid-in capital to actually shares issued. Okay? So what's going to be our entry each year? Well, there's no forfeiture here. So each year, guess what? We're going to do the exact same entry for these restricted stock units. We're going to debit our compensation expense for 1/3 over the vesting period. If it was a 5-year vest, then it would be divided by 5. So when we're talking about this, don't overthink it. It's simply the total amount of compensation that they're going to earn at the time of grant We're going to divide it over the vesting period, 3, 5, 10, whatever the years are. In this case, it was 3. So we're going to take that 64.8, we're going to divide it, and each year that our employee works, they're going to go in and earn 1/3 of that. Now, on December 31st, let's see, where does it say? Well, it doesn't say that we actually handle them, but let's say and do the December 31st, 2020. We're at the end of our 3 years. So all of 18, all of 19, and all of 20. So that's 3 full years that our employees have worked and they have now vested in our company. So when we go in on December 31st, what do? Well, all we do at that time is we hand out shares. Now keep in mind, our employees are not going to pay anything in as owners. They've earned it through work. So we're going to remove that restricted shares of stock that we've got out there for 64.8, paid in capital restricted shares. If you want to abbreviate that, I'm happy with PIC. Paid in capital to me is always PIC. So if it's paid in capital dash whatever, or you can do paid in capital in excess of par, I do PICIP, and we'll see that in just a moment. So anyway, PIC on our restricted shares, that's paid in capital. And then what are we doing? Well, we're actually issuing those 8 million shares of stock. Well, what are we going to issue common stock? Well, remember, common stock accounts, just make a note here, they're always carried at par. So we go up, what did it say our par was? Well, it said $1 par value common shares to key personnel. So this $1 is our par. So anytime we hit common stock, we must actually hit it at the dollar par in this case, or whatever par is in the problem you're looking at. And then finally, how do we close this out? Well, to close this out, we're going to go in and we're going to hit paid in capital in excess of par. And remember, I call that PICIP if you've watched any of my other videos. So paid in capital in excess of par, and I always like to denote what type of stock it is. So paid in capital in excess of par, or I call it PICIP, on our common shares. And remember, that's all the value above par. So that's going to be the 64.8 minus the 8. So that's going to give us 56.8 in total. So that's the amount we would actually record in our PICIP account. All right. So that's just an example of restricted stock units. That's normal. If nothing strange happens, that's how you would account for an RSU. You would initially record nothing until the end of each period. Now, we would footnote it, of course. Anytime you have restricted stock units, you have to denote it, even if you haven't recorded the full expense yet. You have to inform your investors that you do have these stock awards going out at some point, so it does have to be footnoted. As far as journal entries go, we actually do a journal entry at the end of each period of the vesting until it's fully earned, and then we give out shares of stock. Okay? So hopefully that is a little example of how to handle the accounting for a restricted stock unit.